I'm on QuickBooks Online on a sample company, Craig's Design and Landscaping Services, and wanted to speak with you guys in regard to loans and why it's so important to track loans on the books for bookkeeping purposes and for tax purposes. So, two major reasons why we want to track your loans on the books. And a lot of clients, when they first come on board with us, either their prior CPA or bookkeeper hadn't been tracking loans on the books correctly, or they just haven't been tracking it at all, and it really affects the client in regard to tax purposes as well and accuracy. So I'm going to go to the chart of accounts. So what kind of loans am I referring to? So there are different loans, right? So maybe you purchased a F-250, or maybe you purchased a skid steer. Any loans that are attached to your assets, vehicles, machinery, and equipment. So any loans that have to deal with business purposes, maybe you have a shop, you took out a mortgage. Any loans regarding that should be on your books as part of your long-term liabilities. You'll see it as notes payable, loans payable, or you may see it if you financed your truck through Ally, maybe Ally payable, and so on. So when you have a loan on the books, it's supposed to be reconciled every month or at least once a year, right? And we reconcile our clients' loans every single month. And so every month you get a loan statement from the bank that you're financing your, let's say, your vehicle through, right? And it in that bank statement, it tells you, okay, for example, you may pay $200 for your truck payment, and $100 went to straight to principal, and the other $100 went to interest expense, right? So in the reconciliation process every month, what we do is we pull up the loan document, the bank statement, and what we do is we post the payment to the loan, and then we would separate principal and interest, and this is very important because interest expense that gets posted on your profit and loss statement. So now you have your profit and loss showing your interest expense on that loan every single month. And therefore, at the end of the year, when you go and do your taxes, you have your loan balance on your balance sheet, right? And then you have your interest expense on the profit and loss, which is used as a deduction for your tax purposes. So you're all ready to go, right? But what happens is where the problem area is when bookkeepers or CPAs have never reconciled loans before, therefore interest expense is never being posted on the books on your profit and loss, and then you never get to take advantage of that deduction, right? But also your books are not being tracked accurately as well, because you won't see the loan on your balance sheet statement. So you're losing out on interest expense for the life of that loan, and then you're losing out on having correct financial statements. So it's very important to keep track of the loan. And I'm going to show you how to post a loan to your book. So this may look a little bit differently because I'm in a sample file on QuickBooks Online, but you should have the same function. So you will go to New, and you'll have a journal entry. So let's say this month you purchased a truck and you're financing that truck. So I'm going to put here, I'm going to name it truck 1, And I'm going to, for account type, it's a fixed asset. And then for detail type, it's a vehicle. And that's going to be a debit. Let's say you paid $40,000 for that truck. That's what it's worth. And let's say that you put 5%. You put 10,000 down. All right, for that truck. Let's look. Okay, so that would be owner's investment, because you're making that $10,000 investment down payment towards that truck. Right? And now the loan that you're having on that truck is $30,000, because that's the 40 minus the 10 that you already put down, so you're financing $30,000. And that's your notes payable. Oh, 1. So then this credit is increasing owner's investment by $10,000. It's increasing your liabilities, your notes payable, by $30,000, and it's increasing your truck, your assets, by $40,000. So we have debits equals your credits, right? Perfect. Now you've recorded your loan on the books. But now, let's say that it's month 1 of, now you have to pay your truck, right? So, so what you'll see here is a payment towards the truck. Normally, it will come from your checking account. And let's, for example, I know this is MasterCard, but let's put it towards the truck. Oops, no, towards the loan. $900 towards the loan. Going back to the loan, I see my $900 here of payment. Oh, I'm sorry, this was not. It's not transferring over correctly because this is a sample account. All right, so basically what you would want to do is you'll go to banking, and then the banking, under the banking section, it downloads all of your transactions, right, that you're making each month. And you'll see that, oh, here's my payment that I made towards my loan, $228. I'm going to put that towards my my note payable, right? And then once you put it towards the loan, and you receive your, just ignore that says Hicks Hardware. Let's pretend this is your loan payment to the truck. And let's say you have your bank statement pulled up, right? And the bank says that you've paid $10 towards interest. So then you will want to go in here and put interest expense. You have your $10, and then you're going to, because your full payment was $228.75. That's how much you paid the bank, but $10 of that was interest. So only $218.75 went towards principal. So now you're splitting up principal versus interest for this payment, and you're hitting save. And then when you go back to your loan, now your loan has a new balance here for $29,771.25, right? That's your new loan balance. That is what went towards principal versus what went towards interest. So now if you go to your reports, right, and you go to profit and loss, you should be seeing your interest expense on your profit and loss, which is here, the $10, right? So that's why it's so important to make sure that when you purchase your machinery, your equipment, your truck, your shop, whatever it is, that you post the loan on your books. That way you can track how much you owe. But not only that, every time you make a payment towards that loan, it should be classified under the loan, so that way your liability is decreasing. But not only that, you're separating principal from interest, right? Because we started off with a full payment of $228.75, but $10 of that went towards interest expense. So then $218 towards principal, you're left with $29,781.25 for your loan liability. And then we saw how that affects the profit and loss, because now you have $10 of interest expense on your profit and loss statement. So I see that happen a lot with my clients. They're paying a lot of truck payments or machinery, equipment loans, and then I say, oh, like, I don't see the liability on the books and I can't accrue interest expense. But that's because your prior CPA or bookkeeper never put that loan on the books, and now they've missed out on so many years of not deducting interest expense on their profit and loss, and now their net income is higher, therefore their taxes are higher. And in a landscape company, it is so it's so common, that we make a lot of investment upfront, and sometimes we don't have all the cash to put, to buy our trucks, to buy our equipment, and therefore a lot of the clients have loans, right? And unfortunately, it's not recorded correctly. So you want to make sure everything's on the books, recorded correctly from the beginning for tax purposes, bookkeeping purposes. And again, like, once you have your, and this is something else, but once you have your assets on the books, your trucks, your machinery, equipment, your trailers, all of that good stuff, you want to make sure you're tracking depreciation for those assets that you have on your books. So if you, what's going on is that what I see often is that the truck will be on the books, but then not the loan. That's what I see. A common mistake is the truck is on the books and then the loan is not on the books. So then you will ask, okay, well, where does every month the client is making a payment towards that loan, where does that loan payment go towards if there's no liability? We just spoke about how it's supposed to go towards this liability account. The payment is supposed to be categorized under the liability. So what happens when a bookkeeper or CPA makes a mistake and they don't post a loan, they just post a truck? The payment, unfortunately, for you, will, if they post it wrong, it's going towards owner's equity. And what that's doing is all the payments for every month is going towards equity. And since it's an expense, it's lowering your equity in the business. It's decreasing it, because now it's saying that, now what that's saying is, oh, this is a personal expense. Let's put it towards owner's equity. Let's not put it on the loan, on the books. Let's just put it, all the payments towards owner's equity, and that's being putting as a personal expense. Therefore, now that payment, now they're not even separating principal versus interest, which is deductible. Like I said, the whole amount is just going towards owner's equity, which is wrong. So, or it's just either not just not on the books at all. So those are the two common things that you may see. And then what happens is, if the bookkeeper or CPA has been doing it like this way for years, where the payment is going towards owner's equity, and that's the way it's been recorded on the books, and that's the way it's been recorded for tax purposes, now when we will take it over, we have to follow what they've done, unless you amend all of those prior tax returns with the interest expense and everything posted correctly. Because now tax returns have been filed for multiple years, books are closed, and unfortunately you have to stick with the way that, even though it's wrong, you would have to stick with the way that it's been done before, because taxes have been already filed. And so that's why it's so important to do it right from the beginning, right? So just thought that was, I just see it so often, unfortunately, and I just wanted to shed some light on it and the importance of it. So if anybody, has any questions or anything, please let me know. If you have any questions about loans or assets or anything like that on the books, please shoot me an email at carlap@cyclecpa.com. But thank you for joining today, for those who did, and have a nice day. Bye.